Coming up today, stocks drop lower on the back of new tariffs. Wall Street cuts their price targets. Fear continues to build. The latest from the Fed. And is there light at the end of the tunnel? It's going to be a good one, guys. Let's go. Well, surprise, surprise, the market is down, led by growth shares on the back of a fresh tariff announcement, which I'll get into in a minute. Reversing a bit of the trend we've seen of late with mega cap tech coming off today, well, defensive sectors actually caught a bid there. And we've now technically got the S&P 500 retesting Monday's low, actually took it out by a few points today. And if we were to gap fill on Friday's close, that would be 56.67, where I'll be looking for the market to find some support. And so like I was saying yesterday, it was a bit of a low volume bounce. We coiled up there on a low range, spinning doji yesterday. No real surprise to see a bit of a retest, and that was led lower by mega cap tech. And stick with me today because later on in this video, I'll show you what I think could be one of the most undervalued stocks in the market. It actually has over half of its market cap sitting in cash on the balance sheet, and it's exposed to AI. I think you'll find that interesting. But just looking at the moves we've got here in the market today, VIX popping up a little bit, now just above 18. Term structure is still in contango, haven't gone back into the dicey zone yet. And we actually saw a bit of a bump up in the government bond 10-year yield, along with the dollar firming somewhat as well, as concerns over a trade war and the possibility the Fed may not be able to come to the rescue given persistent inflation fears. Along with fresh tariffs is what's likely got the yields in dollar higher today, along with a bit of a pullback in growth stocks. And just going down to the 5-minute chart on the SPY, we did get signs of a bit of late day buying, but have peeled them back a little bit after hours here as I speak. And that's due to fresh tariffs, which just hit the wires as I'm making this video. The president announcing 25% tariffs on all cars not made in the States. And this comes ahead of the deadline, April 2nd, when sweeping reciprocal tariffs are set to go into effect, with once again the point of this tariffs to encourage domestic production, foreign investment in the States, along with bringing down the cost of American-made vehicle, incentivizing patriotic buying. And so I just asked Grok, the chatbot coming from XAI, can you give me a list of major automakers in the US and what percentage of their vehicles sold in the US are produced in the US? So it went and scrolled the web and scraped some data for me. Coming in up the top, no surprise. Tesla assembles all vehicles sold in the US at its plants in California, Texas, and Nevada, making it the only major automaker with 100% US production for its domestic sales. Ford, 77%, General Motors, about 54%, Chrysler, Dodge, Jeep, and Ram, 70%, Toyota, 50%, Honda, 73%, and so on, looking at some other Asian and European automakers. And then I went on to ask Grok, so if the US government placed 25% tariffs on all vehicles not made in the US, that would benefit Tesla the most? And of course, the answer is yes. And that's why even though the market is off a bit here after hours, Tesla's actually trading up around 2%. While General Motors has taken a bit of a haircut here, down over 5%, along with Ford as well, down 4.3% after hours, along with a few of the foreign automakers. The market quickly pricing this in. But it's not just the automakers. The market's worried this could spill over to other sectors, with potentially Nvidia in the firing line, and why we've likely seen some constraint on the upside, even though we've been getting good fundamentals coming in on Nvidia, new products and growth. China and the US are both enacting policies that could make it tougher for US companies to sell advanced AI chips in China. The States doesn't want China to have their advanced AI chips, and China's having to bite back on tariff threats to save face. But I don't think they're going to want to block advanced AI chips coming into their country. That's more coming from the US side. Plus, it's been widely speculated they largely get around that by selling via Singapore. But nonetheless, the market is a little spooked here today. Nvidia hasn't been able to recapture its 50-day VWAP in this bounce yet. Coming off pretty hard there today, over 5%. So as we can see, still plenty of volatility in this market. Growth shares bumping around. And in fact, the Mag 7 is on track to have its worst quarter since the bear market of 2022, as we've only got a few more trading days left in Q1 this year. But this does kind of remind me of 2018, what's going on in the market at the moment, which, like back then, was on fears of tariffs, which didn't actually materialize. And so we saw a really swift correction in the market. It was actually bigger than this one now. But there wasn't a slowdown in growth or growth expectations. So it was more of a multiple compression, like what we've got going on now. And so 2018 was actually a bit of a tough year to trade in the market. Just looking at the Vanguard Growth ETF here, ran up hard coming into the year. Then we got that Volmageddon. Sharp volatility spike, consolidated for a few months, ran back up into Q3. Then Q4 was a complete washout. President famously came out back then, said there was a glitch in the stock market, which turned out to be true because we had a massive 2019. Then of course, the events in early 2020. But just looking at where we are now, nowhere near as bad of price action. So for sure, we could still have a few more months of up-down volatility here, making our way through all this tariff mess. but I don't think he wants to have trash in the economy causing a recession on his legacy, because they're already hinting at shuffling them around, showing leniency, exceptions, ongoing discussions, negotiations. This is just one big negotiation, as he's representing his people to try and get better trade deals with their major trading partners. But in the end, I think everybody will meet in the middle and they'll get something done, even if it has to get worse before it gets better. But alas, it's plenty of fodder for the media to play with. Another day, another call for recession, which, if it were to happen this year, would be one of the fastest U-turns for the economy. So we're just coming off a 3-handle on GDP last year, and then to start sinking into negative territory in just a few short quarters would actually be an amazing feat. It would also totally prove the bond market wrong as well, given how low high-yield bonds are and they're spread over top of treasuries. But in true Wall Street fashion, the banks pile in on top of one another, cutting their end-of-year S&P 500 target. Barclays came out again today, joining a bunch of others in trimming their forecast. They all started the year really hot, doing the complete opposite of last year, which they all started low. Now they're bringing them all down, with many institutional investors thinking the place to hide out is going to be Europe. In fact, we've seen the highest level of EU outperformance versus US stocks year to date, going back 20 years. And there's a look at the daily chart on the spread between the S&P 500 and the Euro stocks, which to me looks like it's already turned, especially on the weekly chart here. Huge sharp sell-off. That to me kind of looks like a reversal pattern and a bottom, especially on my reversal signals on the weekly chart here, which are kind of similar to what we saw at the end of last week on Tesla, as I pointed out to you guys. But no doubt, technically, this bull market is getting tested. Looking at one of the other leaders, Nvidia, had a strong run up for a couple of years. Now have consolidated for over 6 months. Really be looking for $100 to be defended, potentially down into the mid-90s. Could get tested if we do see another spike in fear or any negative headlines to do with China and chips. But if the market's going to make new all-time highs next quarter or later on this year, we're going to need to see a few of these stocks do the same thing. There's a look at Apple, also in a consolidation pattern. Microsoft, somewhat testing its support here as well. Amazon still looking a bit better, and Meta probably looking the best, as it's barely consolidated for the last couple of months. But one thing we've got going on is consumer sentiment is really low. And will that translate into actual lower consumer spending in Q2, which is another thing the market is worried about? As we just heard, consumer confidence index come in at multi-year lows yesterday. And inside of that are consumers' expectations for stock prices over the next year. And we've just seen the biggest 2-month collapse in people expecting stock prices to increase. Also, in a recent study, 51% of Americans see a big market crash on the horizon, up from 46% in Q4 last year. Also, 75% said they're worried new tariffs will punch up their cost of living expenses. Also translating into the majority of them thinking inflation is going to get a lot worse. Keep in mind, these are pretty good contrarian signals. When a lot of people think something's going to happen, we can quite often go the other way, as consensus is quite often wrong. Looking back in history, when the majority of consumers think we're going lower in the market, it's actually a good time to buy the dip. But just keep in mind how people are feeling, what they expect, and how they answer surveys doesn't always match up with what's actually happening. Because just looking at the consumer confidence index yesterday, a large part of the fall was driven by consumers over 55 years old. Because looking at millennials, confidence actually rose a little bit. And like we've been noting, mainstream media pushes fear on a good day, but of late, they've gone into overdrive. And most of those traditional cable news channels are watched by those same category of people over the age of 55, getting their minds filled with fear all day. It's no wonder they're answering the surveys with a little uncertainty and sour expectations. And we can especially see that in the 1-year inflation expectations from the University of Michigan, sharply spiking up this month to 4.9% of what a lot of consumers think inflation's going to do over the next year. But like I always say, you got to take these surveys with a grain of salt, if not a jar, because there's a big political element inside of them, in addition to recency bias and other herding effects. In fact, just looking at the Michigan survey, the majority of respondents are Democrat, which it should come as no surprise, especially the mainstream media news outlets that they may watch are not exactly backing the new president. So it's not all that surprising in the current environment when we don't actually know what the tariffs are going to be and the results, that it's really easy to push fear right now. But buried in today's headlines was durable goods orders actually coming in quite a bit better than expected. They're actually expected to contract. They actually rose almost 1% in February. No doubt a little bit of front loading with the tariffs, but a key input into the economy, and good to see it's not fallen off a cliff. as the whole point of the new admin's mandate is to reinvigorate domestic production and manufacturing. And so that could already be getting started. And there's a look at the hard data on durable goods, excluding transport, actually posting a 2-year high today. And the Federal Reserve's GDP now forecast, which everyone was freaking out about 2 weeks ago because they were forecasting negative 2.8. Their latest estimate is negative 1.8 growth in GDP this first quarter. However, if you read the fine print, their alternative model forecasts, which adjust for imports and exports of gold, is actually positive 0.2%. Like I said, we're going to get a bit of volatility here in Q1 in economic data from the impacts of tariffs and front loading, the change of government, change of spending. It's quite a lot of recalibration to get through here. And at the end of the day, valuations aren't that bad. For sure, the S&P 500 ain't all that cheap with a forward PE a bit above 20, but it is filled with global dominant businesses that are still growing. Bond yields are only around 4%, so that's a forward yield of 5%. Stocks are still yielding more than bonds, and especially so looking at small caps and mid caps, sitting around 15. That's approaching an almost 7% forward earnings yield on small caps, and is actually more closer to the bottom end of their range over the last 20 years. So it's hard to make an argument that small caps are crazily overvalued. And so it always astonishes me how fixated people are on the S&P 500 index, like it's the only thing you can invest in, or all your investing decisions should be based on the S&P 500's valuation. The world's filled with different assets us retail investors can invest in with the click of a button. Even staying on the NYSE and NASDAQ exchanges, you can get exposure to all over the world in many different asset classes. So yes, very well, the Mag 7 may trade sideways this year, just based on taking a breather, fears of tariffs, maybe a bit of rotation. But like I said, there are other options out there for us investors. Looking at Chinese tech stocks, still only trading around 17 times earning. Huge valuation gap between the states. China's been written off for years now, and I think we'll potentially see more partnerships between Chinese and European companies, potentially looking to skirt US tariffs. We just heard a new partnership between Alibaba and BMW today to bring artificial intelligence into their cars, as the Chinese have made leaps and bounds just over these past couple of months with their chatbots abilities. And that company I mentioned at the start of this video, I was going to share with you, which I think could be one of the most undervalued stocks in the market and actually has over half of its market cap in cash and exposed to AI. That's Baidu, kind of like the Google of China. In fact, it's the 12th most cash-rich company in the world after it's mostly mega cap tech. Taiwan Semi, Saudi Aramco, and of course Berkshire. They're at the top. Baidu's got 19 billion on their balance sheet in cash, with a market cap just over 33 billion. In other words, that's about 57% of their market cap in cash. Pretty solid cushion to lean against. Recent quarter just came in really good, 33% beat. And just going out to the monthly chart there, looks to be finding this long-term support. Been a lost decade for the stock, like most of the Chinese market, even though the economy's continued accelerating in that time. And my own stock fair value indicator has it as quite undervalued as well. And technically, we're seeing signs of accumulation here on the chart. Seem to be defending this $80 level pretty good. And even though we've had a little bit of a bounce this year, still really hasn't broken out of its multi-year bear market yet. But to me, this looks like we could be completing the end of a stage 4 decline and getting through a stage 1 accumulation phase. So again, there's more options to us investors than just the S&P 500. If you believe that is in a crazy bubble ready to crash, like the majority of consumers do, there's plenty of other quality stocks that trade on the NASDAQ and come with good valuations. And there's a look at the semiconductor ETF. Like I said, we're kind of hanging around this support zone, which has been there for about a year now. And so the way I see the AI trade is we may indeed have completed phase 1. That's the mass infrastructure build out to support real world AI application. And so obviously the beneficiaries from that have been the chip makers, data centers, and somewhat energy providers, although I think electricity has a long way more to go. The chips have certainly had a good run the last couple of years, but phase 2 could be real world AI applications, companies that are set to use that infrastructure and AI to generate revenue. I think the next big beneficiaries will be robotics, autonomous vehicles, software, and then some other things like augmented and virtual reality. I think a big beneficiary could be Uber and any other company that can benefit from the AI hardware getting cheaper. And then beyond phase 2, real world AI application, I think phase 3 will likely be where the real societal impact and disruption takes place. As even though there will always be jobs for humans, at least management, potentially some sales, systems monitoring, engineering, high-level programming, I think largely over the next 10, 20 years, there will be labor displacement. Capitalism, at least, very much changing, if not going into post-labor capitalism. And that'll be certainly interesting to see how that all plays out. Because a lot of these physical jobs being done by humans today and many industries will eventually get replaced by robots. Then what are all those people going to do? My guess is universal basic income, because not everyone is going to be a robots systems designer. But anyway, that's more of a long-term secular trend. Most people are more obsessed with what's going on this week or this quarter, including the Fed. They don't even know how all these tariffs are going to play out. They're really walking the line, playing it cautious here, worried that it could see a bump in inflation that's beyond Jay Powell's favorite word, transitory. As we've still got signs of inflation around the world. Actually got bond yields in Japan hitting the highest level since the GFC, 2008. Look at that run up in the 10-year JGB, really swift there. But I'd say this is more a return to normalization. So it was kind of mind-blowing just a few years ago. We had negative bond yields, not just in Japan, but also in parts of Europe. Big institutional investors were paying to lend their money out. And as stupid as that sounds, it's because they've got a mandate. They have to have certain allocations to bonds, no matter the yield. But on the other hand, across the Atlantic, United Kingdom, inflation cooled to 2.8%. Still a bit above mandate, but I guess their economy is not as strong and has actually kind of been flatlining a bit. So you wouldn't want to see inflation on a 3 handle. That's really kind of a stagflation scenario over there. So we are getting a little bit of dispersion and inflation around the world. No real clear trend up or down, kind of just bumping along sideways. But like this meme suggests, the market is at the mercy of tariff headlines, back and forth, back and forth. And it could very well stay like that until we get some material trade deals. Europe may need to technically go into recession to come to the table. It'd be really good if India got a first mover advantage and came out and did a big blockbuster deal and got ahead of the pack. That would more likely incentivize China to come to the table. Then if you've got India and China coming to the table, maybe Mexico as well, spotlight will be on Europe and they should get something done quickly as well. And this could all happen within a few weeks. Otherwise, it could very well drag out for the rest of the year. At this stage, the truth is nobody knows. And so the market is a little technically soft here. Russell 2000 hasn't been able to reclaim its 50-day VWAP yet. There is still plenty of rotations going on underneath the surface. We can see that in sector breadth. So it wasn't a complete washout of a day. And my market risk on off indicator still highlighting the chart green here. But bond yields are not getting created or pricing in a recession as it stands. The narrative is more like it's inflation coming back, which we're going to hear more about this Friday, core PCE. That comes in hot, no doubt will get the market nervous, but if not, we may get another crush in volatility. Along with a look at GDP tomorrow, could get the market moving. And VIX 9-day still a little higher than the 30-day as we go into official tariffs next week. So like I said, the market and some key stocks are getting tested at the moment. We'll really be looking to see if all this negative sentiment does translate into lower consumer spending and how are all these companies going to guide for Q2. Hear from them in a few weeks. That'll be the next thing the market will be keen off. Otherwise, for now, it's a bit of back and forth action as volatility is well and truly back in these markets. That's all I got for you today. Thanks very much for sticking with Click Capital. I'm always interested to hear your thoughts, so post your comments below this video. Otherwise, I'll see you back here again this time tomorrow. Cheers.